Towards the end of 2018, you mentioned that you guarantee you could make a 50% annual return if you had to start again with under $1 million. The question is, if tomorrow you woke up in the body of a
your body.
20-year-old
Yeah,
American.
Your body. But that's fine.
And your name was now Warren a la carte. And you had some money to invest on a full-time basis. What method or methods would you use to achieve that return?
To answer your question, I don't know what the equivalent of Moody's manuals or anything would be now, but I would try and know everything about everything.
Did you know that if you had invested $100,000 in Apple back in 2010, your investment could be worth nearly $4 million today? This phenomenal growth is due to Apple's stock price rising from around $30 at the beginning of 2010 to around $170 in 2024. While that ship has sailed, the opportunity to grow substantial wealth hasn't. Today, we're focusing on 3 of Warren Buffett's favorite dividend stocks, where a $100,000 investment still holds promising potential for substantial growth. In this video, I'll show you how and why these stocks offer such powerful opportunities for both dividends and capital appreciation. We will go into detail about each stock that Buffett recommends, predict their financial returns, and talk about the solid fundamentals that support its expected performance. I will also show you 2 different ways to invest $100,000 in these 3 stocks. One will give you $1.4 million in 30 years, and the other will give you $2.5 million in the same amount of time. Let's get started by breaking down these top picks from one of the greatest investors of our time. When we look at Warren Buffett's approach to investing, we find a philosophy rooted in the basics of value investing, a strategy that focuses on picking stocks that appear to be trading for less than their intrinsic or book value. Buffett isn't just looking for good deals. He's looking for companies with a competitive advantage that are likely to perform well over the long term. What really sets Buffett apart is his emphasis on companies that pay dividends. Why dividends? Because they provide a steady income stream and are often a sign of the company's financial health. Buffett values these stocks not only for their profit potential, but also for their stability. He often says, "Our favorite holding period is forever," highlighting his focus on long-term growth and steady returns, rather than quick profits. Buffett's strategy includes looking for companies with what he calls a moat. A moat is a unique advantage that protects the company from competitors, much like water surrounding a castle. This could be a strong brand identity, proprietary technology, or industry dominance. Anything that makes it tough for another company to swoop in and take their market share. By applying this philosophy, Buffett does more than just pick stocks. He picks companies that he believes in. He invests in their future, their people, and their plans. And more importantly, he looks for those that are undervalued by the market, providing an opportunity to buy quality stocks at a discount. This disciplined approach not only minimizes risk, but also maximizes the potential for steady, long-term returns through dividends and capital appreciation. Understanding this foundation is important as we look deeper into the specifics of the stocks Buffett favors, helping us grasp why he might choose one stock over another and how each fits into his broader investment strategy. There are 3 standout stocks that exemplify his investment criteria. Each of these companies not only aligns with Buffett's demand for business with durable competitive advantages, or moats, but also shows a consistent track record of dividend payments, contributing to their appeal as long-term investment options. Coca-Cola, or KO, is often the poster child for Buffett's investment philosophy. Buffett began buying shares of Coca-Cola in 1988, and it has remained a fundamental component of his portfolio due to its strong brand loyalty and global market presence. Coca-Cola not only offers a significant dividend yield, but also demonstrates resilience during economic downturns. Its global brand recognition and vast distribution network serve as a significant moat, which has helped sustain its market-leading position and enabled consistent dividend growth. Kraft Heinz, KHC, another significant holding, reflects Buffett's preference for companies with essential products and strong brand identities. Despite some volatility in recent years, Kraft Heinz remains a major player in the food industry, offering stable dividends. Its extensive portfolio of products provides a diversified source of revenue that supports its dividend payouts, making it an attractive option for dividend-focused portfolios. Apple, or AAPL. While a newer addition to Buffett's portfolio, quickly became one of his largest holdings. Apple's innovative edge and consumer loyalty contribute to its moat, while its significant cash reserves allow for substantial and growing dividend payouts. Under Buffett's investment, Apple represents a blend of growth and income, with its expanding services sector bolstering overall revenue and enhancing its ability to maintain and increase its dividend over time. These three companies not only comply with Buffett's investment criteria, but also demonstrate the potential for steady growth and reliable dividends. Each company holds a significant position in its respective market, supported by competitive advantages that protect and sustain its profitability. Investing in these companies does not just mean betting on their current success, but also banking on their continued market dominance and ability to adapt to changing economic landscapes. For investors, understanding the reasons behind Buffett's selections helps in modeling an investment strategy that replicates his success. Let's look deeper into the financials of the three Buffett-endorsed stocks: Coca-Cola, Kraft Heinz, and Apple. By examining key financial metrics such as high dividend yield, payout ratio, earnings growth, and market performance, we can gain insights into why these stocks are favored by Buffett for dividend-focused portfolios. Coca-Cola has long been synonymous with consistent dividend growth, making it a top choice in income-generating portfolios. As of the latest financial data, Coca-Cola offers a dividend yield of approximately 3.1%. This is significantly higher than the average yield of the S&P 500, making it an attractive option for dividend investors. Coca-Cola's payout ratio, the percentage of earnings paid to shareholders as dividends, typically hovers around 75%. While this may seem high, Coca-Cola's strong cash flow supports this payout, which shows its commitment to returning value to shareholders. The company has increased its dividends for 59 consecutive years, illustrating a reliable income stream. Even during economic downturns, Coca-Cola's global brand and extensive distribution network have helped maintain steady sales, underpinning its dividend reliability. Financially, Coca-Cola has maintained a healthy balance sheet with moderate debt levels, ensuring its dividends are well covered by free cash flow. Kraft Heinz presents a more complex case. The company offers a high dividend yield of around 4.5%, which is attractive to investors looking for immediate income. However, its payout ratio has long been a point of contention, often exceeding 100% in recent years, which can be unsustainable in the long term without significant earnings growth. The company's financial challenges peaked in 2019 with a significant write-down of its brand value, leading to a dividend cut. Despite these challenges, Kraft Heinz has stabilized somewhat under new management, focusing on reducing debt and streamlining operations. Its broad portfolio of consumer goods provides a defensive posture against market volatility. For investors, the key to valuing Kraft Heinz lies in its recovery potential and ability to maintain and slowly grow dividends as its restructuring progresses. Apple's approach to dividends is relatively recent compared to the other two, having started to pay dividends again in 2012 after a hiatus since 1995. However, its dividend growth rate has been impressive, with increases averaging over 10% annually since it resumed payouts. Apple's current dividend yield stands around 0.6%, which is low compared to many traditional dividend stocks, but is complemented by extraordinary capital appreciation. Apple's payout ratio is quite conservative, at about 24%, indicating substantial room for future dividend increases. The company's financial health is strong, with a massive cash reserve of approximately $200 billion, allowing flexibility for further share repurchases and dividend increases. Apple's revenue growth, driven by its diversified product ecosystem and services, supports sustained increases in shareholder returns. When assessing the total returns, including both dividends and capital gains, each of these stocks has demonstrated strong performance over the long term. Coca-Cola and Apple, in particular, have shown significant capital appreciation over the years, which, when combined with dividends, has resulted in impressive total returns. Kraft Heinz has had a more modest capital growth, but its higher dividend yield has compensated to some degree. Now let's explore the financial outcomes if you invest $100,000 one time across Coca-Cola, Kraft Heinz, and Apple without additional monthly contributions. Then, we'll also look into the scenario where you add $500 monthly for 30 years. Starting with Coca-Cola, with its 3.1% dividend yield and a history of 6% annual dividend growth, coupled with 5% capital appreciation, the initial $33,333 investment could evolve significantly. By reinvesting dividends, after 10 years, your Coca-Cola investment might approach approximately $55,000, grow to about $90,000 in 20 years, and reach around $150,000 by the 30-year mark. Kraft Heinz, offering a higher initial yield of 4.5%, but with a modest 1% dividend growth and 2% capital appreciation due to recent challenges, presents a different growth trajectory. From the same initial investment, you might see your investment grow to about $45,000 in 10 years, $60,000 in 20 years, and $80,000 after 30 years. Apple, with a modest initial dividend yield of 0.6%, but impressive dividend growth of 10% and capital appreciation of 12% annually, shows the most substantial growth potential. From an equivalent investment, the projected growth could be around $110,000 after 10 years, climbing to $360,000 in 20 years, and potentially reaching $1.2 million after 30 years. Adding these together, without any additional monthly investments, the total value of your initial $100,000 spread across these stocks could be around $210,000 after 10 years, $510,000 in 20 years, and $1.43 million after 30 years. Now let's consider the scenario where you invest an additional $500 per month along with that initial $100,000. For this extended investment strategy, the cumulative effect of continuously investing small amounts significantly enhances the compound interest effect. Within the same rates of return and dividend growth, adding $500 per month could substantially increase the total projected value. Assuming the same rates of return, your portfolio could potentially grow to about $270,000 in 10 years. By 20 years, this approach could yield a total of around $790,000. Over 30 years, continuously investing an additional $500 per month could see your total investment grow to nearly $2.5 million. This assumes the additional investments receive the same rate of return as the initial investment, compounding the overall growth of your portfolio. These projections provide a clear picture of how a significant one-time investment, coupled with consistently smaller contributions, can lead to substantial wealth over time, leveraging the growth potential of well-selected dividend stocks. Each calculation takes into account reinvested dividends, demonstrating the powerful impact of compounding over extended periods. This approach follows Warren Buffett's principles of buying quality stocks at reasonable prices and holding them for the long term. In a 30-year span, the financial landscape of your investments can drastically transform depending on your strategy. If you stick a one-time investment of $100,000 distributed among Coca-Cola, Kraft Heinz, and Apple, the total value of your investment could reach approximately $1.43 million, assuming dividends are reinvested and the companies continue their historical performance. However, if you enhance this strategy by additionally investing $500 each month, the power of compounding becomes even more evident. Over the same period, with consistent monthly additions and the reinvestment of dividends, your portfolio's total could swell to nearly $2.5 million. This big difference illustrates the substantial impact that regular, smaller investments can have when combined with a significant initial investment. Investing in stocks like Coca-Cola, Kraft Heinz, and Apple involves weighing potential risks against possible rewards. While these companies offer stability and substantial dividends, market volatility, economic downturns, or company-specific issues can affect stock performance. For example, Kraft Heinz has faced challenges that have impacted its stock value and dividend stability, pointing out the importance of diversification. Conversely, Apple's significant growth potential carries the risk of high valuation, which could suffer during market corrections. By understanding these dynamics, investors can better manage expectations and make informed decisions. It is important to weigh these risks against the chance of long-term growth and steady dividend income. This is in line with Buffett's strategy of picking fundamentally strong companies that can handle changes in the economy and provide consistent returns. What are your thoughts on adopting Buffett's investment strategies? Would you consider investing in these stocks, and why? Share your perspectives in the comments below, and don't forget to like and subscribe for more insightful investment strategies. Until next time, keep investing wisely.